And now it's time for development debates. We dig deeper into some of the questions shaping the future and present of China. Today, we'll see two Chinese experts debating if China will suffer a debt crisis this year. The National Audit Office report denied the country's extreme local government debt issue. However, it still makes experts debate if the debt crisis would happen this year. According to the report, by the end of the first half in 2013, local government debts reached 10.8 trillion yuan, or $1.8 trillion US dollars. This number has seen nearly 8.6% in increases compared to the end of 2012. From the end of 2010 until June 2013, local government debt has gone up by 67%. A Fitch Ratings report said that the percentage of China's debt that occupies GDP might increase from 128% in 2008 to 216% in 2013. Fitch Ratings warned that if the Chinese government still could not control its debt amount, by 2017, the percentage might soar to 271% of its GDP. An economist for Standard Chartered, Stephen Green, has an argument coming from a similar vein. He told the Wall Street Journal that the possibility of a debt default from local governments might surpass 50% this year. This would be the first time that China suffers from a debt default. Stephen Green says China's economy saw over 10% in annual increases during the past 3 decades. However, is mainly relying on government investment. He says that after the 2008 global financial crisis, these kinds of investments are more reliant on bank loans. Some failed government projects make debt repayment become difficult. Stephen Green also mentioned how China's overheated real estate market is proof of how serious China's debt issue is. He says that the emergence of China's ghost towns is a consequence of low-quality government investment. Although building real estate might improve China's economy in the short term, these ghost towns would become a heavy financial burden for the local government if no one would like to buy it. Local governments would have to repay the huge debt with this fiscal revenue. This would squeeze out spending on social issues. He says that this would affect social stability in the end. Stephen Green suggests the central government allows some of its debts to default. He believes this could warn local governments and financial institutions of how serious the debt risks are. But financial columnist Ye Tan doesn't support Stephen Green's idea. Ye says that the Chinese government would do whatever it can to avoid a debt default. Ye referred to a recent case to prove her idea. In late January, the government avoided a 3 billion yuan trust product default. The WMP product was named Credit Equals Gold #1 collective trust product. China Credit Trust loaned 3 billion yuan, or nearly $500 million US dollars, to an unlisted coal mining company named Shanxi Zhenfu Energy Group. China Credit Trust promised investors a 10% annual return rate if they purchase a WMP. However, in January of this year, the China Credit Trust Company told investors they might not be able to get a repayment from one of ICBC's wealth management products. The wealth management product is planning to mature on January 31st. But just 8 days before the maturation date, China Credit Trust announced it had reached an agreement with an anonymous third-party institution to purchase the WMP from ICBC. However, the statement says investors would not be able to receive interest on the third and final year of the product. Ye says based on this case, no trust companies, state-owned banks, or local governments will allow debt default to happen. Therefore, Ye believes China's debt will not collapse until the Chinese government finds a way to ease that problem. Holding local governments responsible for their debts might be able to cut back their voracious appetite for spending, but letting them default without a reliable justice system might lead to unruly and unethical corporate behavior, which might actually be better than defaulting and losing the stability that keeps foreign direct investment in the country. So decision makers will have to tread carefully.